Hello, today let us look at the journal entries, okay? We usually pass journal entries to record financial transactions as they happen, okay? Remember, the purpose of financial accounting is first to ensure that we are able to record the financial transaction as they happen, and then we'll be able to classify and summarize them into financial statements, okay? And the tool that helps us to pass these journal entries is the debit and credit tool, because of the double entry system that the underlying foundation is the accounting equation. So there is the rules of accounting equation that allows us to know when to debit and when to credit, because always the accounting equation has to remain balanced, okay? And the accounting equation is basically assets of a business is equal to the liabilities of a business plus equity, okay? So we are going to expand this equation so we are able to understand the classification of accounts that are usually there, and what do we do when we want to increase a certain account, and what do we do when we want to decrease an account, when we want to record a financial transaction, okay? So in this case, we are going to expand what is equity. And equity basically is it has the stockholder equity, or rather capital, and it has in it retained earnings. Retained earnings is basically taking the revenue that a business has generated during a certain period, a specific period, and lessen the expenses they have incurred. And then from it is still where companies are able to pay dividends, or if it is sole proprietorship, it is drawings, okay? So basically, equity expanded is stockholder capital. Instead of using retained earnings, we are going to say equity is stockholder equity plus revenue, less expenses, less dividends. Dividends, it is a payout to the shareholder. So we are lessing it because it is a cash outflow to the shareholder, okay? So once we understand this, the expanded equation is the assets of a business is equals to liabilities. So what we've done here is expanded equity, which is the stockholder equity. We add the revenue less expenses. This is just a representation of retained earnings. And because from it we pay dividends, because that is the owner, the person who has invested in a business, they want to get something. That is the purpose, okay? That is why we have dividends for companies, and we have drawings for sole proprietorship. So this is basically an expanded, we have expanded equity, okay? So stockholder equity, we add revenue less expenses less dividends, okay? So when we take dividends to the other side of the equation and expenses to the other side of the equation, we are going to have dividends plus expenses plus assets, okay, is equals to the liabilities plus stockholder equity plus revenue, okay? So note this point, okay? We are going to rely a lot on this expanded equation to understand when do we debit to increase account, and when do we credit to increase account. So here we have, when do we credit to increase an account, okay? So on this side, you're going to use this summary. We are going to use dealer. Let us rely on the word dealer, okay? And the first three letters to represent the left side of the equation, and the other the left side of the equation. You can see D stands for dividends, E stands for expenses, A stands for asset. This is just to help you to remember. Then we have L for liabilities on this side. E is for equity, so you don't have to write these S. You can just be using equity. And then we have revenue, okay? So how will that help us? That will help us to know on the left side of the equation, the accounts that are under dividends, expenses, and asset. To increase those accounts, we have to debit. We have to debit, okay? And to decrease them, we have to credit. Basically, what we are saying, all these accounts, to increase them, we have to debit. We need to debit. And to reduce them, we have to credit, okay? So this is the drawings account or dividends account, expenses and assets, okay? So this we have to debit to increase, and we have to credit to decrease, okay? Then we have the other three accounts on the right side of the equation, which are the liabilities, the equity or capital, and revenue, where we credit to increase them and debit to decrease them, which is the opposite of the others. Okay, so here this is the opposite. We credit to increase and we debit to decrease. Okay, so in this here, what we are saying on this side, to increase an account on liability, we are going to credit. So a liability account with a credit balance, that is a normal balance. It just means, let's say for example, a loan payable account, we are going to find that loan payable on the credit side. Okay, and that is a normal, it is a normal credit account. Okay, then we are going to have, if we want to decrease, we now debit these accounts. Okay, so let us look at examples. Remember, when a transaction happened, two things happens. Okay, two things happens always. So you need to identify what is happening. First, you need to identify the transaction, see what is happening, and then identify the accounts that are being affected by this transaction. Okay, for example, let us look at this first transaction, where we are told the owner of BM Traders deposited shillings 100,000 in the business bank to start the business. We ask ourselves, what is happening here? They have deposited 100,000. Where? In the bank. What does that mean? That means there is a cash account that is being affected. There is a cash account that is being affected. Let me be specific. This we are being told is in the bank, so we are going to call it cash in bank. Okay, cash in bank. We can call it cash in bank account. Okay, what is happening? The business had a zero balance. The business has had a zero balance. Now it has gone all the way to 100,000. What does that mean? That means there is an increase in the cash in the bank. Okay, and what the cash account is, what type of an account? A cash account is an asset. It is an asset account. An asset is a resource that the business is controlling. Is cash a resource, an economic resource? Yes, it is an economic resource, and the business can control it. It can use to buy stock. It can use to buy machineries. Okay, so basically cash is actually a current asset. Okay, so what do we do when we want to increase an asset account? You come here and check. What do? We always debit to increase that account. Okay, so in this case, what are we doing? We need to increase this account. So the first journal entry will be to debit cash account an amount of 100,000. Okay, so what is the other thing that is happening? Remember, when a transaction happens, there is always at least two things that are happening. That is why you will always find that there is entries at least two. They can't be less than two. They have to be. You can't just debit. You can't record a transaction by just debiting. No. It's always at least two things are happening. Okay, so in this case, we are told the owner of BM. What does that say? This is capital. This is capital because remember, what we call equity or rather capital, it is the owner's share. Okay, we usually say the liabilities is what the business owes the third party, and the equity is what the business owes the owner. So in this case, this is the initial capital injection into the business. We need to record that capital. Okay, what do we do to record? Remember, let's say for example, BM Traders, the owner of BM are not deposited anything in the business before. Let's assume that. So what is happening to this capital account? What is happening to the capital account? First, the business had a zero balance. It never had any. There wasn't any amount of money there. This owner had deposited before. Okay, so now it has gone to to 100,000. So this owner has increased what they have injected in the business. Okay, so there is an increase in the capital account. What do we do to show an increase in the capital account, or rather the equity account? Recall, we credit to increase a capital account. So that is why we come here and say credit capital account. Okay, so you see we have a set of a journal entry. This is what is going to be passed, and always the debits have to be equal to the credits. The debits have to be equal to the credits for every transaction. Okay, so in this case, you can see we are debiting 100,000 and we are crediting 100,000 because the owner's share is now 100,000 and the cash the business has received is 100,000. Okay. Now let us look at another example where we are told the business bought 10 television in cash at shillings 20,000 each. Okay. So in total, the business bought 10 multiplied by 20,000. They bought televisions worth of 200,000. Okay. They bought televisions worth 200,000. So basically, first let us tackle this equation because the first thing, the next transaction, because the first thing I'm going to ask you, where did the business get 200,000 and they are bearing in cash? It is because they had taken a loan. So first let us tackle this loan. So they had taken a loan of shillings 100,000. The moment they took a loan, how do we go about it? How do we go about it? We need to identify the accounts that are being affected. When the business took loan, what happened to the cash account? When you take loan, they give you that money, right? So we have an increase of 100,000 in the cash account. Okay, and then what is happening on the other end? You are taking an obligation to come and pay this loan. So you will always, the business will have a present obligation of paying this loan. So basically there is going to be a record of loan payable, which is a liability account because it is a present obligation that dictates we are going to pay this amount of money, or basically there's going to be an economic outflow of a certain resource from the business. Okay, so we need to record that we have a loan payable, and this is an increase in this account. Let's say for example, at the beginning of the period we had we have not taken any loan. Now we have taken a loan, so we have increased from 0 to 100. So that is an increase to the loan payable account. And how do we record that? To show that there is an increase in the cash account, which is an asset account, we usually debit that account. Okay, so we are going to debit 100,000. Okay, what about loan payable? The loan payable is a liability account, and here we have an increase in the loan payable account. And for liabilities, what do you do to increase that account? You actually credit. Okay, so you see here we are going to have credit. You can see we are crediting, but we are not reducing this account. No, we are crediting to recognize an increase in that account. So loan payable, we are going to credit loan payable account an amount of 100,000. Most people confuse that to debit is only to inflow and credit to outflow. No, it depends on the accounts that you're looking at. Okay, so loan payable is a liability account, and to increase it you have to credit that account. Okay, now let us come back here, knowing now this business now it has 200,000 to be able to buy these televisions with cash. Okay, so we have 200,000. So how do we record this? Remember, when you go to buy televisions, you receiving the televisions, right? And then you are giving out the cash. Okay, you're giving out the cash. And these televisions, this business is for buying and selling television. So these televisions are inventory. Okay, they are inventory or rather stock. So what has happened to the inventory account? What has happened to the inventory account? We had 0 televisions at the beginning of the period, but now we have increased them from 0 to 10. So we need to increase to recognize that increase. On the other end, what has happened? We have paid in cash. So meaning cash account has gone down. It has gone down by 200. Okay, it has gone down by 200,000. So how do we record this? We debit inventory account. Inventory account, what is it? The type inventory account is an asset account. Okay, it is an asset account. So we debit to increase it. So we are increasing it with an amount of 200,000. Okay, then we are going to credit cash. Cash is an asset account, and to decrease it, what do? We have to credit. Okay, because now this time round we want to decrease it, and it is an asset account, so we credit cash account an amount of 200,000. Okay, so basically for every transaction that happens, you have to identify what is happening, which accounts are being affected. Always when a transaction happens, there is give and take. There is two things. There are at least two things that are happening. Okay, so you need to be able to record those things with the debit and credit, and always remember the debits and credit to record a certain transaction should always be equal. Okay, so this is basically what you need to remember. To the first 3 accounts, which is dividends, expenses, and assets, to increase them we debit, and to decrease them we credit. Okay, so use the first 3 letters of the word dealer. Okay, then the other 3 accounts, which are liabilities, equity or capital, and revenue, we credit to increase them and debit to decrease them. So that is the last 3 letters of the word dealer. Okay, so always have that in mind. Okay, it is going to know which journal entry you're supposed to pass at a particular when a certain transaction happens. Okay.